VIX is a trademark ticker symbol for the Chicago Board Options Exchange Market Volatility Index, a popular measure of the implied volatility of S&P 500 index options. Often referred to as the fear index or the fear gauge, it represents one measure of the market's expectation of stock market volatility over the next 30-day period. The idea of a volatility index, and financial instruments based on such an index, was first developed and described by Professor Menachem Brenner and Professor Dan Galai in 1986. Professors Brenner and Galai published their research in the academic article New Financial Instruments for Hedging Changes in Volatility, which appeared in the July-August 1989 issue of Financial Analysts Journal. In a subsequent paper, Professors Brenner and Galai proposed a formula to compute the volatility index. Professors Brenner and Galai wrote our volatility index, to be named Sigma Index, would be updated frequently and used as the underlying asset for futures and options. A volatility index would play the same role as the market index play for options and futures on the index. In 1992, the CBOE retained Vanderbilt University professor Robert Whaley to develop a tradable stock market volatility index based on index option prices. At a January 1993 news conference, Professor Whaley provided his recommendations, and subsequently, the CBOE has computed VIX on a real-time basis. Based on the history of index option prices, Professor Whaley computed daily VIX levels in a data series commencing January 1986, available on the CBOE website. Professor Whaley's research for the CBOE appeared in the Journal of Derivatives. The VIX is quoted in percentage points and translates, roughly, to the expected movement in the S&P 500 index over the upcoming 30-day period, which is then annualized. VIX is a registered trademark of the CBOE. Specifications: the VIX is calculated and disseminated in real time by the Chicago Board Options Exchange. Theoretically, it is a weighted blend of prices for a range of options on the S&P 500 index. On March 26, 2004, the first ever trading in futures on the VIX began on CBOE Futures Exchange. As of February 24, 2006, it became possible to trade VIX options contracts. Several exchange-traded funds seek to track its performance. The formula uses a kernel-smoothed estimator that takes as inputs the current market prices for all out-of-the-money calls and puts for the front month and second month expirations. The goal is to estimate the implied volatility of the S&P 500 index over the next 30 days. The VIX is calculated as the square root of the par variance swap rate for a 30-day term initiated today. Note that the VIX is the volatility of a variance swap and not that of a volatility swap. A variance swap can be perfectly statically replicated through vanilla puts and calls, whereas a volatility swap requires dynamic hedging. The VIX is the square root of the risk-neutral expectation of the S&P 500 variance over the next 30 calendar days. The VIX is quoted as an annualized standard deviation. The VIX has replaced the older VXO as the preferred volatility index used by the media. VXO was a measure of implied volatility calculated using 30-day S&P 100 index at the money options. Interpretation: the VIX is quoted in percentage points and translates, roughly, to the expected movement in the S&P 500 index over the next 30-day period, which is then annualized. For example, if the VIX is 15, this represents an expected annualized change of 15% over the next 30 days. Thus one can infer that the index option markets expect the S&P 500 to move up or down 15% per USH 12 equals 4.33% over the next 30-day period. That is, index options are priced with the assumption of a 68% likelihood that the magnitude of the change in the S&P 500 in 30 days will be less than 4.33%. The price of call and put options can be used to calculate implied volatility, because volatility is one of the factors used to calculate the value of these options. Higher volatility of the underlying security makes an option more valuable, because there is a greater probability that the option will expire in the money. Thus, a higher option price implies greater volatility, other things being equal. Even though the VIX is quoted as a percentage rather than a dollar amount, there are a number of VIX-based derivative instruments in existence, including VIX futures contracts, which began trading in 2004, exchange-listed VIX options, which began trading in February 2006. VIX futures-based exchange-traded notes and exchange-traded funds, such as S&P 500 VIX Short-Term Futures ETN and S&P 500 VIX Mid-Term Futures ETN launched by Barclays iPath in February 2009. S&P 500 VIX ETF launched by Source UK Services in June 2010. VIX Short-Term Futures ETF and VIX Mid-Term Futures ETF launched by ProShares in January 2011. Similar indices for bonds include the MOVE, LBPX indices. Although the VIX is often called the fear index, a high VIX is not necessarily bearish for stocks. Instead, the VIX is a measure of market perceived volatility in either direction, including to the upside. In practical terms, when investors anticipate large upside volatility, they are unwilling to sell upside call stock options unless they receive a large premium. Option buyers will be willing to pay such high premiums only if similarly anticipating a large upside move. The resulting aggregate of increases in upside stock option call prices raises the VIX just as does the aggregate growth in downside stock put option premiums that occurs when option buyers and sellers anticipate a likely sharp move to the downside. When the market is believed as likely to soar as to plummet, writing any option that will cost the writer in the event of a sudden large move in either direction may look equally risky. Hence high VIX readings mean investors see significant risk that the market will move sharply, whether downward or upward. The highest VIX readings occur when investors anticipate that huge moves in either direction are likely. Only when investors perceive neither significant downside risk nor significant upside potential will the VIX be low. The Blacker-Scholes formula uses a model of stock price dynamics to estimate how an option Euro unregistered trademark S value depends on the volatility of the underlying assets. Criticisms. VIX is sometimes criticized in terms of it being a prediction of future volatility. It is a measure of the current price of index options. Despite their sophisticated composition, critics claim the predictive power of most volatility forecasting models is similar to that of plain vanilla measures, such as simple past volatility. However, other works have countered that these critiques fail to correctly implement the more complicated models. Some practitioners and portfolio managers seem to completely ignore or dismiss volatility forecasting models. For example, Nassim Taleb famously titled one of his Journal of Portfolio Management papers "We don't quite know what we're talking about when we talk about volatility." In a similar note, Emanuel Derman expressed his disillusion with the enormous supply of empirical models unsupported by theory. He argues that, while theories are attempts to uncover the hidden principles underpinning the world around us, as Albert Einstein did with his theory of relativity, we should remember that models are metaphors, analogies that describe one thing relative to another. Michael Harris has argued that VIX just tracks the inverse of price and it has no predictive power as a result. History. Here is a timeline of some key events in the history of the VIX index. 1987, the Volatility Index was introduced in an academic paper by Professor Menachem Brenner and Professor Dan Galai, published in Financial Analysts Journal, July-August 1989. Brenner and Galai wrote, "Our volatility index, to be named Sigma Index, would be updated frequently and used as the underlying asset for futures and options. A volatility index would play the same role as the market index play for options and futures on the index." 1992, the American Stock Exchange announced it is conducting a feasibility study on a volatility index, proposed as the Sigma Index. SI would be an underlying asset for futures and options that investors would use to hedge against the risk of volatility changes in the stock market. 1993, on January 19, 1993, the Chicago Board Options Exchange held a press conference to announce the launch of real-time reporting of the CBOE Market Volatility Index or VIX. The original formula for VIX was developed for the CBOE by Professor Robert Whaley and was based on CBOE S&P 100 index option prices. 2003, the CBOE introduced a more detailed methodology for the VIX. Working with Goldman Sachs, the CBOE developed further computational methodologies, and changed the underlying index, the CBOE S&P 100 index, to the CBOE S&P 500 index. 2004, on March 26, 2004, the first ever trading in futures on the VIX index began on the CBOE Futures Exchange. Nowadays the VIX is proposed on different trading platforms, like XTB. 2006, VIX options were launched in February 2006. 2008, on October 24, 2008, the VIX reached an intraday high of 89.53. Between 1990 and October 2008, the average value of VIX was 19.04. In 2004 and 2006, VIX futures and VIX options, respectively, were named Most Innovative Index Product at the Super Bowl of Indexing Conference. See also, Hindenburg-Omen, Stock Market Bottom, IVX, Volatility Index, S&P ASX 200 VIX, Volatility Index, China Raja CA Euro OE Volatility Index Demystified, From Measure of Uncertainty to an Asset Class a Euro. The Actuary India Magazine PG 45. Bibliography, Brenner, Menachem, and Galai, Dan. New Financial Instruments for Hedging Changes in Volatility, Financial Analysts Journal, July-August 1989. Brenner, Menachem, and Galai, Dan. Hedging Volatility in Foreign Currencies, The Journal of Derivatives, Fall, 1993. Amex explores volatility options, International Financing Review, August 8, 1992. Black, Keith H. Improving Hedge Fund Risk Exposures by Hedging Equity Market Volatility, or How the VIX Ate My Kurtosis. The Journal of Trading, Connors, Larry. A Volatile Idea. Futures, PA 36 Euro 37. Connors, Larry. Timing Your S&P Trades with the VIX. Futures, PPA 46 Euro 47. Copeland, Maggie. Market Timing, Style and Size Rotation Using the VIX. Financial Analysts Journal. PPA 73 Euro 82. Digler, Robert T., and Laura Rossi. A Portfolio of Stocks and Volatility. The Journal of Investing, Fleming, Jeff, Barbara Osteek, and Robert E. Whaley, Predicting Stock Market Volatility, A New Measure, The Journal of Futures Markets 15, PPA 265 Euro 302. Hulbert, Mark, The Misuse of the Stock Market's Fear Index, Barron's, October 7, 2011. Moran, Matthew T., Review of the VIX Index and VIX Futures, Journal of Indexes, PPA 16 Euro 19. Moran, Matthew T. and Srikant Dash. VIX Futures and Options, Pricing and Using Volatility Products to Manage Downside Risk and Improve Efficiency in Equity Portfolios. The Journal of Trading, Sado, ed. VIX Futures and Options a Case Study of Portfolio Diversification During the 2008 Financial Crisis. Tan, Kupin. The ABCs of VIX. Barron's, P. MW 16. Tracy, Tenil. Trading Soars on Financials as Volatility Index Hits Record. Wall Street Journal PG. C6. Whaley, Robert E., Derivatives on Market Volatility, Hedging Tools Long Overdue, The Journal of Derivatives 1, PPA 71 Euro 84. Whaley, Robert E., The Investor Fear Gauge, The Journal of Portfolio Management 26, PPA 12 Euro 17. Whaley, Robert E., Understanding the VIX. The Journal of Portfolio Management 35, PPA 98 Euro 105. References, Brenner, Menachem, Van Galai, Dan. New Financial Instruments for Hedging Changes in Volatility, Financial Analysts Journal, July-August 1989. http People's-Stern-Nyadya Research FAJ Article on Volatility Der PDF, Brenner, Menachem, and Galai, Dan. Hedging Volatility in Foreign Currencies, The Journal of Derivatives, 4, 1993. http People's-Stern-Nyadya Research JOD Article of Vol Index Computation PDF, Robert E. Whaley, 1993, Derivatives on Market Volatility, Hedging Tools Long Overdue, Journal of Derivatives 1, 71-84 http Root Consulting Files WordPress.com 09/JD93 PDF, Introduction to VIX Options and Futures, VIX White Paper. Retrieved September 20, 2010. Note that the divisor is ASH12, not 12. See the definition volatility for a discussion of computing interperiod volatility. http www.wallstreetdaily.com 08 Picture Perfect Trade This Market / Cumby, R. Vigilewski, S. Hasbrook, J. Forecasting Volatility and Correlations with Agag Models. Journal of Derivatives 1, 51 doi, 10.3905/Jod 1993.407877 Jorian, P. Predicting Volatility in Foreign Exchange Market. Journal of Finance 50, 507 528 doi, 10.1111 per Joule 1540-6261.1995 TBO 4793X. JSTORA 2329417 Anderson, Torben G. Boleslav, Tim. Answering the Skeptics, Yes, Standard Volatility Models do provide accurate forecasts. International Economic Review 39, 885 €905. JSTORA 2527343 http Papers SSRN Compapers CFM. Abstracted equals 970,480. We don't quite know what we are talking about when we talk about volatility. Derman, Emmanuel, Models Behaving Badly, Why Confusing Illusion with Reality Can Lead to Disaster, on Wall Street and in Life via Euro, ed. Free Press. http www.reichactionab.com 2012 on the zero predictive capacity of VIX / http www.reichactionab.com 2012 further analytical evidence that VIX just tracks the inverse of price / index product awards. Retrieved January 5, 2008. External links, Bloomberg page for VIX, IND, Yahoo! Finance page for VIX.